Welcome back, business enthusiasts. My name is Dr. Kasha Suarez, and today let's dig deeper into that financing options topic. Part 2. What are the financing options to purchase a business and how they work? So we have some more left for you from part 1. Whether you're a seasoned entrepreneur looking to expand your business portfolio or someone that just wants to own your first business, you want to understand your financing options for you. So grab your notebooks because I'll be digging more into this topic, some of the topics we left behind in part 1, and we'll uncover these today. Since we covered most of the financing options in the last video, today let's focus on venture capital, angel investors, crowdfunding, and online lending platforms. Before we get started, make sure you hit the notification bell so you don't miss any valuable content from me, and hit the subscribe button. Ready to begin? Let's get started. Venture capital and angel investors are another exciting avenue, especially if you're eyeing a high growth startup. Let's explore how to attract these deep-pocketed backers, the terms you'll likely encounter, and the trade-offs of bringing in investors onto your board. Venture capital and angel investors bring more than just the capital to the table. They provide the expertise, the connections, and the mentorship, making them invaluable partners, especially for startups that have aggressive growth ambitions. Venture capital firms are always on the lookout for promising startups to invest in. So how do you attract their attention? You want to craft a compelling business plan that showcases your startup's growth potential and scalability. Then demonstrate that your business has gained traction, whether through user engagement, revenue, or other performance indicators. You'll then want to hone your pitch to convey your vision clearly and convincingly to them. It should address the market problem, your solution, and why you are the right one for the team to execute it on. You'll then want to leverage your professional network and attend startup events and pitch competitions to then connect with those potential venture capital investors. Now, angel investors are typically high net worth individuals who invest their own capital in startups. How do you appeal to them? Well, angel investors often invest in businesses where they have personal connections or deep industry expertise. So building that strong relationship can be the key. Demonstrating that your business has a proven concept or early customers can be a significant plus to them. Like with venture capital, having a compelling pitch is crucial when courting those angel investors. You want to find angel investors who align with your vision, your goals, and your values because their mentorship can be invaluable beyond the funding. Note that when dealing with venture capital and angel investors, you will probably encounter several key terms. Investors typically receive equity in your company in exchange for their investment. The percentage they own is determined by the amount they invest and the valuation of your business. The valuation is the assessed worth of your startup. Negotiating a fair valuation is crucial to ensure you're not giving away too much equity. Vesting schedules dictate how and when investors gain ownership of their equity stakes. It's often tied to milestones or timeframes. So you want to lay it out to them on those common exit strategies that will help them exit the business or the acquisition and get a return on their investment. Now, while securing venture capital or angel investments can be exciting, it's also essential to consider the trade-offs. Do note that while securing venture capital or angel investments can be very exciting because it's also essential to consider the trade-offs. Investors often bring industry expertise, guidance, and valuable connections to the table. These investors provide the capital needed for rapid growth and scaling. Attracting investors can validate your business model and attract further interest from customers and partners. But keep in mind, investors typically have a say in the business decisions, and they may dilute your ownership stake. With external funding, there can be an added pressure to meet growth targets and expectations. Also, investors expect an eventual exit, which could mean selling the company or going public. So you need to keep in mind, is this something you want to keep long term, or do you hope to plan it in the near future if you have investors to help them exit the business? Up next, let's talk about crowdfunding and online lending platforms. The digital age has brought on more opportunities in regards to the crowdfunding and online lending platforms as alternative financing methods. Let's look at how platforms like Kickstarter, Indiegogo, and peer-to-peer lending can help fund your business acquisition. Crowdfunding has transformed the way entrepreneurs raise capital. Platforms like Kickstarter and Indiegogo allow you to be able to harness the power of the crowd to secure funds for your business acquisition. If you're interested in these options, you will first want to start by creating a campaign. In this campaign, you'll outline your business acquisition plan, your goals, and what backers can expect in return for their support. Individuals interested in your project, these backers, they pledge funds to your campaign. They can choose from various tiers of support, each offering different rewards or incentives. You then set a funding goal that represents the amount you need for your business acquisition. You must reach or exceed this goal within a specific time frame for the campaign to succeed. Promoting your campaign is crucial. You'll use social media, email marketing, and other channels to reach potential backers. You want people out there to know what you want funding for. And if your campaign successfully reaches its funding goal by that deadline, you will receive the funds and the backers will receive their reward. Next, the peer-to-peer or P2P lending platforms like Prosper and Lending Club have also revolutionized the lending landscape by connecting the borrowers directly to individual lenders. You can start a loan on P2P lending platforms by providing details about your business acquisition and financial situation. Individual investors, they review those loan applications and then decide whether to fund them. Your loan may be funded by multiple lenders. Keep that in mind. If your loan is funded, you'll receive the capital and agree to the loan terms, including those interest rates and repayment schedules. You then repay the loan, including the principal and the interest according to the agreed upon schedule. Note that crowdfunding and P2P lending, they do offer several advantages for business acquisitions. Crowdfunding platforms can connect you with a global audience of potential backers. Multiple individuals can contribute to your campaign or your loan by reducing the reliance on a single source. You can often also negotiate terms that suit your specific needs, such as repayment schedules and the interest rate. However, there are some considerations, like always, to keep in mind. Successful crowdfunding requires well-executed campaigns, including compelling marketing and rewards planning. Also, the P2P lending interest rates may be higher than traditional loans, depending on your creditworthiness. Also, crowdfunding and P2P lending platforms, they often charge a fee for their service. So that's also important for you to keep in mind. So there you have it, an overview guide of these other creative financing options, in addition to what we shared in part 1. Now let's quickly dive a little bit into the due diligence process and financial planning as well. We've been talking about due diligence, and we're going to keep talking about it because it's a critical part of a business acquisition process. You want to assess the financial health of a business you're eyeing on. You want to conduct thorough research and create a sound financial plan for success. This is a critical phase before you sign any checks. Like I mentioned in previous videos, the due diligence process is the foundation of any successful business acquisition. It's a process of examining carefully and evaluating every aspect of the business that you want to purchase. Remember, this includes looking at the financials, the operations, the legal matters, and so much more. When it comes to financial due diligence, here are some of the key things to consider. You want to request and thoroughly review the business's financial statements, including those balance sheets, those income statements, the cash flow statements for the past few years. Not just this year, the past few years. You want to also look at the tax returns to verify the income and the expenses. Also assess the state of accounts receivable, the money owed to the business, and the accounts payable, the money that the business owes to others. You want to analyze the business's profitability trends and identify any irregularities, and also scrutinize the business's debts and liabilities, including any loans, leases, and pending legal obligations. You want to determine the value of the business's assets, including the tangible assets like all the equipment they have, and the intangible assets like the intellectual property. You'll also want to examine customer contracts and financial implications because there can be some. And look and evaluate the business's cash flow patterns and the sustainability because that's going to be key. There's also operational due diligence. This is beyond the financials. This is equally as critical. Study the market that the business operates in, including the competitors, any of those trends that you find, and growth potential. You want to ensure that the business complies with all relevant laws and regulations in its industry. You want to also assess the relationships that the business has with employees and vendors, as well as verify the ownership and the protection of the intellectual property assets. There's also legal due diligence. This is as equally important because issues could arise and impact the acquisition. Review all contracts and agreements, including leases, licenses, and supplier contracts. During the legal due diligence, this is where attorneys are important because they want to help assess and review the language for you that you might not be familiar with to make sure that you are making the right decision. You will also want to investigate the business's history of litigation, including any ongoing or pending cases, if there are any. You want to ensure that the business owns or has the right to use all the intellectual property necessary for its operations. Now, once you've completed all your due diligence, the next step is to create a sound financial plan for your new business venture. You want to develop a detailed budget that outlines your projected revenues and expenses for the first few years of ownership. Then implement cash flow management strategies to ensure that you have sufficient working capital. You'll also want to create financial projections based on historical data and market research to set those realistic goals. You want to develop contingency plans for unexpected financial challenges in the market shifts because the market does shift. And lastly, determine how much you need to invest initially and plan for future investments to grow that business. Now, to wrap this segment up, here are some expert tips for successful business acquisitions. As I said, always seek advice from legal, financial, and business professionals to help guide you through the due diligence and financial planning. You want to stay up to date on industry trends, market conditions, and changes in regulations that could impact your business. You want to also maintain meticulous records of all the due diligence activities and financial planning decisions. Next, identify and mitigate any potential risks that may arise during the acquisition process. And finally, in conclusion, due diligence and financial planning are the unsung heroes of a successful business acquisition. Remember that all this knowledge and all this insight you will need to help make that informed decision and help navigate through all the complexities that you come across. Now I want to wrap things up with some inspiring case studies. I'll introduce you to real-life entrepreneurs who use different financing options to acquire businesses successfully. These stories are proof that your dream acquisition is within reach. Let's dive into these stories of determination, creativity, and entrepreneurial spirit, because we all have that. So meet Sarah. Sarah is an aspiring entrepreneur with a passion for artisanal coffee. Who doesn't love coffee? I love coffee. She dreamt of owning her own coffee shop, but needed financing to make it happen. Sarah decided to explore SBA loans, a popular choice for small business acquisition. Sarah faced some challenges securing the traditional bank financing due to her limited collateral and experience in the coffee industry. She turned to the SBA, the Small Business Administration, for a 7A loan, which provided favorable terms for her and partially guaranteed the loan. Success with the SBA loan, she acquired an existing coffee shop and transformed it into a thriving business. The loan's lower down payment and longer terms made it quite accessible for her, and she realized her dream of being a coffee owner was within reach. Now let's look at another example. Michael, a tech-savvy innovator who had a brilliant idea for a tech startup, but needed funding to bring it to life. Traditional loans weren't the right fit for his venture, so he then turned it to the crowdfunding for support. Michael's startup idea was innovative but unproven. He didn't have the proof, making it tough sell to traditional investors and lenders. He launched a crowdfunding campaign on Kickstarter, showcasing his vision and offering backers early access to his products. Michael's campaign was a resounding success exceeding his funding goal. With the support of backers, he was able to develop and launch his tech company, which has since gained substantial user base and investor interest. Let's look at one more example. David, an experienced professional who spotted a great opportunity to acquire a struggling local manufacturing business. However, he didn't have the cash on hand for the purchase. David lacked that necessary capital for a traditional acquisition. So he negotiated an equity exchange deal with the current owner. In exchange for a percentage of the business, David agreed to take on the challenge of turning it around. His expertise and dedication paid off, and over time, he revitalized the business and increased its value. As he delivered on his promises, he then bought out the previous owner's equity stake, becoming the sole owner of a thriving manufacturing company. So these examples demonstrate that there's no one-size-fits-all approach to financing a business acquisition. Entrepreneurs like Sarah and Michael and David, they leveraged various methods to achieve their goals, from SBA loans to crowdfunding to equity exchange, and there's so many more opportunities. As you embark on your business acquisition journey, remember that creativity and determination, as well as the right financing strategy, can lead you to success. If you have any questions about specific financing options or want to share your own success story or challenges, please feel free to do so in the comments below. I love reading others' experiences as well. Remember that the opportunities are endless. There are so many financing options out there, and you can get creative with them. Each option has its own advantages and challenges, so do stay informed and choose the right option for you. Make sure you get all the necessary information to make the best educated decision for you and your business venture. Thank you for joining me today, and thank you for watching. Like always, make sure you hit the thumbs up button or share with any entrepreneurs that you know that might find this video valuable. And also hit the subscribe button if you haven't. Until next time, happy business ventures. Bye-bye.